Hey guys, what's going on? So today we're going to be checking out Citigroup, and we're going to be looking at this company because there's really been a lot of issues with the bank sector lately. A lot of banks going down. Everybody knows it's not any secret. Um, so I went ahead and I've never really been a bank investor. I haven't known much about banks. I've spent a lot of time researching banks and balance sheets and kind of trying to figure out um, what we're looking at here when we're looking at their SEC filings, their 10Ks, their 10Qs, their deposits, and basically trying to come up with a value on these companies and if they're healthy. Um, Anyways, what we're going to be looking at here is Citigroup because from what I've seen is this is the I don't know if I would say the most healthy. It is very healthy, very healthy. But I don't know if I would say that's the reason I bought it. I bought it obviously one for health. Another reason I bought it was for scale. They are very, as I see it, they're a huge bank, well diversified, and that is true. You can look at their 10K, 10Q. You can look at any of that. They're well diversified through their brokerage, through multiple types of loans, whether that be consumer or whether that be uh, you know industrial. They have many different types of loans, so there would have to be a lot of macro. There have to be. They're not too heavy on one thing. They have roughly they could cover about 70% of all deposits, and that's with quick or money. Quick money. I mean, they could cover the rest of that if they really needed to. But we're looking at almost 1.4 trillion dollars worth of deposits. So, 1.4 trillion, you wouldn't expect that to be flowing out of the bank. And I actually am a believer. I don't know how popular opinion this is that the macro banks, the large banks, huge institutions, J.P. Morgan, Citigroup, Bank of America, I think these companies are going to see influxes of cash on their balance sheets due to some of the fear in the market. I think they're going to see a lot of um, money coming in because people feel safe in these huge institutions, too big to fail. Um, I think that's what we're going to see rather than your small town, uh, you know, your smaller regional banks. So here's what we're looking at. Okay, so Citigroup. I had bought my shares around $43 per share. I put a few thousand into Citigroup. We're sitting up here at 46. I mean, we're not going to sit here and clap our hands, But what we're looking at here is mainly the valuation. So if you look at the max chart, obviously it looks really bad back in 2007, 2008. They did have I think it was a 10-for-1 reverse split. So that is a large reason why the stock price looks so horrible on a macro chart. But obviously it looks cheap over the past 5 years. If you go look here, the key metric on banks, you're looking at price to book. The reason price to book over PE and I mean banks are going to trade at lower PEs anyways. Mainly because price to book, it's what's left. It is here. Let's go here. Price to book value. So basically, it is your total assets minus your total liabilities. And if you had to completely liquidate the company, because banks are what they are. They're money. They're not. They're not product. They're not. That's the assets they have. The assets they have are the cash that they are owed. And so this is the amount of money, $216 billion, that would be left to the shareholders. If the bank had to liquidate, if it was, done. And so what you do is you put that in a per share. You put that in a per share. So you take your book value. So you take your book value here, and you divide that by the share count, and you'd come up with $111.54 per share. Okay. Now, obviously, the stock price is currently trading around 46, but if you go back to this chart, historically speaking, obviously we're at about 0.45 times book value, or price to book value here. Historically speaking, you are around 0.6, maybe 0.55. For my purposes, I chose 0.6. So if you take 111.54 and divide or multiply that by 0.6, you get a total of $66.90. That is my price target on this company. I think it is kind of, the baby getting thrown out with the bathwater. It's one of these companies that I don't think it has fundamentals that you should worry about. You have a very well diversified bank. I mean, you could look here. Let's take a look. So you got $30 billion in cash, $311 billion deposits with banks. This is money they have within other banks, which is, obviously it's their money. They will be getting that money back. You have securities purchased to resell, so they will be reselling these, they will be selling these. So that's $365 billion. Brokerage receivables, that's $54 billion in money they will receive from brokerage activities. Trading account assets, there's $334 billion in trading account assets. Here is the big thing. Here is the thing that took down Silicon Valley. Here's the major parts here. So here's your available for sale bonds. These are bonds that they can sell today. Don't have to worry about anything. So you have $249 billion, okay? And you have held to maturity of $268 billion. So what you're going to do, Silicon Valley roughly had to sell those at a 20% loss. So if you multiply $268 billion by 0.8, you get $215 billion. If they had to liquidate these right now at at 80% of value, you're still getting $215 billion. It sucks. It's a huge loss, but that's still $215 billion they could get right now. Here's your consumer loans, $368 billion. Your corporate loans, $289 billion. $17 billion for allowance of credit losses. You got your intangible assets, property, plant, and equipment, and $103 billion of other. Now, this was my little total available cash in case of a bank run, and that was my $106 billion, roughly 70% all deposits. Here's your deposits down here, and these are all your liabilities. And some money you have to pay. Obviously, this 806, you're going to have to pay some of this stuff. You're going to have to pay your short-term debt. It's $47 billion. Actually, you could subtract that. You could subtract. I mean, there's a lot of things that you would have to go ahead and subtract. But there's a need for banks. Obviously, there's a need for banks. There's a lot of just scared people out there. What happened with Silicon Valley Bank is a tragedy. But in my opinion, this is my opinion, is that they were way over leveraged in terms of uninsured depositors. And obviously, when you're uninsured and you're in a bank and they're not going ahead and doing good things, and everyone's gonna take their money out. When you're taking your money out, it's a difference when you're uninsured. When you're uninsured and you're not supposed to be insured, then it gives all these people way more, reason to take them out. If you're in a bank like Citi and you got $10,000 in the bank, you're insured. There's no reason for you to take your money out. These people in Silicon Valley got their money in 2 days. They got their money on Sunday. The bank failed, or they got their money on Monday. Access to their money on Monday. Bank failed on Saturday or Friday, and it wasn't a big problem. But if you have, $10 million in the bank, $1 million, $2 million, I mean, you're only insured up to $250,000. There's no reason to keep all that money in the bank. That's why these people pulled their money out. Citigroup, JP Morgan, like Bank of America, Wells Fargo, these are the companies that are going to get a lot of this business. People have to move their money into somewhere else. You can't hide it under your mattress, especially big corporations. And you're getting paid a 4.43% dividend. It was higher when I bought it, and you're gonna be able to sit on that. And yeah, is the macroeconomy is it the perfect time to own bank stocks? I don't know. The problem is by the time you do know that, it's going to be too late. By the time it's up to $78, again, or whatever, it's just going to be too late. You're going to have missed the bus. You got to buy when everyone's selling them, because in the day there are going to be some good opportunities, that that are just getting oversold. And you have to go ahead and you have to do your due diligence and you have to do your research, and you got to look at this stuff. This is the important stuff. This is pulled directly from the SEC. They're 10K, and this is the money. This is where, this is what's available. This is what's available. This is your deposits. Are you comfortable with this risk? You can't sit here and if you're looking at banks and you see this number is like 10%, because what happened with Silicon Valley was, first of all, I think it was well concentrated. But if people are worried, and you have other banks that are well focused, highly concentrated on there's a lot of unsecured depositors. What you're going to have is maybe this number is 10%, maybe this number is 20%. Okay, Silicon Valley had 40% of all their deposits, requested out in 1 day. So that is insane. But I think if there was 20% uninsured depositor, I don't think the bank would have failed. I don't think so. But I mean, at the end of the day, what you're seeing is you got 70% of all deposits you have, and your uninsured deposit rate is not nearly as high. It's not even half that. It's probably less than 25%. But when you're looking at these numbers, these are numbers you want to see. Book value, tangible book value. All tangible book value is your book value minus your goodwill, because goodwill isn't anything. It's an accounting number. All it is basically how generous of a guy you were when you decided to buy that other business. How much extra did you pay? If the business is worth 20 billion, you went ahead and you paid 24. You had 4 billion in your goodwill. It's It's just an accounting number. Your tangible book value, any of it. I mean, and you compare what you're comparing this book value to is your market cap. So you got $83 billion market cap, $216 billion book value. So this is what you'd assume your company's worth, which gives you an opportunity for, 100% upside. But at the end of the day, what you have to do is minimize your risk. I mean, when you're looking at it and you're looking at your price to book, and you're sitting over at 0.4. Anytime it's been at 0.4, look at 0.42, bam, right back up to 0.69, right up to 0.6. It doesn't sit here very long. You've had a few opportunities. I mean, this is from 2012 to 2015. You're over 5. It just doesn't sit here. And so and with banks too, you want to compare banks to themselves, because take a look here. Take a look. Because when you go ahead and you compare them, so let's compare Citigroup to JP Morgan. What you're going to see really fast is that JP Morgan trades at well above and has traded at well above since 2016. So you're looking at around 7-8 years. It's traded above 1. So when JP Morgan won recently in the past years, 1 has been a good opportunity to buy, around 1 book value, book value, and then you have Wells Fargo. Wells Fargo, you got to look at these numbers, and Wells Fargo looks like this is, something you have to look at. Is 0.87. I mean, this would have been a screaming buying opportunity. It just would have been. I mean, you're looking at 0.51. You got to look at your companies. You got to know what you're looking at. And you can't just compare them to any other one, because you can't compare JP Morgan to Citigroup and say, oh, you have to look at historically what they're doing. So if you're going to do JP Morgan and you were going to look at their book value, and you figured out your book value, what you do, and I actually have JP Morgan over here, what you do is historically for me I decided that it looked like your average book value ratio was about 0.9. So I figured, okay, here's your book value divided by your shares outstanding. I found that, and that ended up being $96.82 per share would be your value. Stock was, at that time I looked it up on the 19th of March, was trading at $124 per share. So that's obviously $30 more expensive than I would like. But the difference between JP Morgan and the difference between Citigroup is JP Morgan is growing their revenue by 10+% a year, and Citigroup's, turtling it over there at around 3%. So you're looking at your book value per share, you multiply that by your 0.9, and you're looking at a target price for JP Morgan around $87.1. And that's the way I value it. And I think that what you need to do, regardless, is buy companies you understand, and just don't stretch it. Don't stretch it. If you don't understand it and you can't wrap your mind around it, then don't buy it. Because the whole thing is, you buy it at $78 and you have no clue what you're buying. You're like, oh, it's at 78, or you buy it, say you buy it here, it's at 65. Oh, it's at 78, like it's at 65. Let's just ride the wave up or something. You can't do that. You can't, because then obviously you lose money, and then who do you have to blame? You have to blame yourself because you didn't do the research. So, but that's all I would say, is that Citigroup has looked like just a great deal in the market, and my price target for is $66.90, and this is the reason why. I feel like they're safe. This is the reason why. 70% of all deposits they have, which is different for all these other banks, by the way. Look at SoFi. 25% of deposits they have. Citigroup obviously 70, 50% over here at Bank of America. Ally 23%, which I was, I was hoping was going to be higher. I like Ally. It looks like a well-ran company, but and their book value, $23 a share, $25 per book value. And JP Morgan, which I had not. Apparently I had not got to that point yet, but it's that 70% is good. It's good. So I would I would encourage you to do your own research, and just be, they say be greedy when others are fearful, and that's true to a point, but also just be educated, so that when opportunities like this come, that you have the know-how to understand, that these companies aren't in trouble, and that this should be their value. You need valuation tactics. You can't just blindly go into something because somebody told you to, or because you think it'll be a good investment, based off of no numbers, based off of no research, based on it's tough. You can always wait. You can always wait and until new information emerges, if you don't have all the information you need. And if they don't release the information you need, then, maybe they're not a good company. Maybe they're hiding something. So, but all right, guys, I hope you enjoyed the video, and I will see you guys again.